So, when a major global crisis hits, you'd expect the markets to totally freak out, right? But what if they don't? What happens when the whole system bends but somehow refuses to break? Today, we're going to do a deep dive into that intricate chain reaction that follows a geopolitical shock. We'll explore how markets process fear and why the final outcome can be so surprisingly resilient.
The headlines were just screaming disaster. A military strike, quick retaliation, threats to a critical global shipping lane. It was serious. And sure enough, the stock market opened with a brutal plunge, down over 2.5% right out of the gate. But by the time that closing bell rang, something pretty remarkable had happened. Most of that loss, it was gone. The market basically stared into the abyss and took a step back.
So, the big question is, how? How does a market soak up a shock like that and bounce back in just a matter of hours? Well, it's not magic, that's for sure. It's actually a really complex dance between risk, fear, and some cold, hard economics. And we are going to unpack exactly what was driving this incredible market comeback.
Okay, so to really get our heads around the market's reaction, we first have to understand what lit the fuse in the first place. Let's just lay out the exact sequence of events that sent these shockwaves across the globe right before the markets opened for the week.
It all kicked off on a Saturday with a U.S. and Israeli airstrike on Iran. By Sunday, Iran had already hit back with drone attacks on a U.S. embassy and even some Amazon data centers in the region. And then, as traders were getting their coffee on Monday morning, Iran threatened to disrupt shipping in the supercritical Strait of Hormuz. That prompted an immediate U.S. military response. It was a really tense, fast-moving 72-hour period.
Now, this is where it gets really fascinating. You see, this single geopolitical spark, it set off this complex chain reaction. It wasn't just one thing that moved the markets, it was a whole series of dominoes falling, one after another. And the ripples went through every single asset class, from oil to stocks to bonds.
In this slide right here, it tells the story perfectly. Just look at the S&P 500. It bottoms out at nearly 2.5% down, but then claws its way all the way back to close just under 1% down. That's an incredible intraday recovery. At the same time, WTI crude oil tells the other side of the story. It spiked a massive 9.5% at its peak before settling down to a more modest, but still really significant 3.7% gain.
This brings us to the market's fear gauge, the VIX. And yeah, it definitely jumped. It shot right past that alert level of 20, but, and this is the crucial part, it did not breach 30. And that level, 30, that's what signals pure, unadulterated panic in the streets. So this tells us that while investors were definitely scared, they weren't just selling everything blindly. They were thinking, they were processing, and they were waiting.
Okay, so let's trace that chain reaction, domino by domino. It all begins right here, with that big geopolitical shock over the weekend. This is our trigger. The very first domino to fall, oil. The threat to the Strait of Hormuz sent crude prices just soaring, almost immediately. Now, this is the crucial link right here. A sustained spike in oil prices doesn't just mean you're paying more at the pump. For the market, it signals a return of that ugly word, inflation, all across the economy. And that fear of inflation is what knocked over the final domino. It triggered that sharp initial sell-off in both stocks and bonds because investors started worrying that central banks would have to keep interest rates higher for a lot longer. Now, the way all these different assets moved, it created some real head-scratchers for investors. Some of the classic safe haven rules just seemed to be broken that day. So let's solve 3 of the most counterintuitive moves we saw. First up, gold. In times of war and uncertainty, isn't gold supposed to be the ultimate safe place to be? So why on earth did it fall right alongside the stock market? Well, the answer is this phenomenon called the dash for cash. See, in a real crisis, big institutional investors get hit with margin calls. That's basically their broker calling them up and saying, hey, you need to put up more cash right now to cover your potential losses. And to get that cash quickly, they are forced to sell whatever they can sell fast. And that includes stocks, crypto, and yes, even their gold. In those moments of extreme stress, the US dollar becomes the one and only true safe haven. All right, puzzle number 2, government bonds. They're another classic safe haven, right? Normally, in a crisis, investors rush to buy them. That pushes their prices up and their yields down. But on this day, the complete opposite happened. Yields actually rose. Why?
This is where our chain reaction comes right back into play. The fear of inflation, which was sparked by that oil price surge, was simply a more powerful force than the typical flight to safety. See, inflation eats away at the value of the fixed payments you get from a bond, which makes them way less attractive. So investors started selling bonds, which pushed yields up. In this fight, the fear of inflation won out over the fear of conflict.
And that leads us to the biggest question of all, the one we started with. Why did the stock market, after that absolutely terrifying initial plunge, manage to stage such a powerful comeback throughout the day? It really came down to two key factors. First, we got a crucial piece of geopolitical news. The U.S. announced that its Navy would escort ships through the Strait of Hormuz. Now, this didn't end the crisis, but it took the absolute worst-case scenario, a total shutdown of oil supply, off the table. And second, there was the psychological boost from a totally unexpected place. In the middle of all the chaos, the retailer Target reported fantastic earnings. And that was just a timely reminder to the market that, hey, despite all the global turmoil, the underlying U.S. economy was still pretty solid. So, we've dissected the what and the why. Let's turn to the what now. How can you, as a long-term investor, use this knowledge to cut through the noise and make smarter decisions the next time a crisis inevitably hits? Here is a clear 4-step playbook. Step 1. Do not panic sell. History shows us again and again that the emotional, initial sell-off is the absolute worst time to get out. Step 2. Wait for the VIX to cross 30. That's your signal of true panic, and, counterintuitively, it's often the best long-term buying opportunity. Step 3. Keep your eye on oil. If WTI crude stays above $80 a barrel for a while, that's when the inflation threat gets real and you might need to adjust. And finally, step 4, buy the dips on your core long-term themes, like AI. Geopolitical shocks don't change fundamental shifts in technology. Which leaves us with one final thought to chew on. What this whole event really teaches us is that the market's biggest fear isn't necessarily the headline-grabbing shock itself. The real, lasting risk is in its economic aftermath. The potential for sustained inflation and how central banks react to it. And understanding that difference? Well, that's the key to navigating the turbulent waters of the global markets.